Okay, hello everyone, and welcome to our May 2022 7 Investing in Focus. This is one of our deep dives into one of the particular market segments that we're very interested in. I'm very excited today to welcome you to Luke Hallard, who's our lead advisor here at 7 Investing. He's going to be giving today's presentation. Luke, you have found one of the best performing segments of the entire stock market, which seems to be an opportunity for investors going forward.
Simon, you and I know what this sector is. It might be a surprise to some of our listeners, though. What is one of the market's best performing sectors of the last couple of years? Software as a service, SaaS. Today, we're going to do a bit of a whirlwind tour through what is software as a service. We're going to look at what's happening in the stock market to SaaS companies. We're going to take a look at some interesting business metrics. So if you're doing your own investment research on SaaS companies, give you a couple of tools you can look at to understand the quality of some of those investments potentially. I've then got 3 great software as a service investment ideas for you. I'm looking forward to it. Should we get into it?
Absolutely, Luke. And just a reminder for anyone who's unfamiliar with 7 Investing, Luke is a lead advisor with our team, which means every month he's giving his best idea in the stock market. We issue all of those as recommendation reports and we present them to our members. If you are interested in 7 Investing, our website is 7investing.com or 7investing.com/subscribe if you'd like to get started and see even more of Luke's favorite ideas. So Luke, I'm going to hand it back to you. Let's learn about software as a service.
Great stuff, Simon. Well, what is software as a service? So they're a really special kind of tech company, software company. And what's special about them is they offer their products to customers through the internet for a monthly subscription, basically a pay-as-you-go model. It's a bit like leasing software. This is actually a really interesting model as an investment. If you think about old-style software companies, and I used to work for a big bank, and actually I led the purchase on a couple of really big software deals for us. The majority of the revenue for that software company is captured at the time of the purchase. Maybe you buy like a whole bunch of licenses that are going to run for 5-10 years. And then the software company is going to collect small revenues, kind of maintenance fees along the way. Software as a service is really different though. Almost nothing typically upfront. You lease the software, perhaps on a per user or per transaction basis, and the revenues are highly recurring. It's a fantastic business model, actually. Very high gross margins. These companies hang on to a lot of the money they earn because they're actually quite capital light, just like they're leasing their software to their customers. They're actually renting their infrastructure and their hardware from the big hardware platforms like Amazon's AWS, Google Cloud Platform, Microsoft's Azure. They have really low costs up front to mobilize, and it means they can scale really quickly. Now, the really interesting thing about software as a service companies as well is they have what's known as a land and expand business model. Now, again, if I go back to my old days evaluating big software vendors, we would engage at a global level. Typically, if it was a really big deal, you'd have to get procurement on board, and often you go up to the CTO if you're buying a piece of software to get their endorsement to the spend. Well, actually, land and expand is a completely different model. The developer themselves, perhaps in a smaller company, can just put down their own credit card, buy a license, or even maybe a freemium, download the software, just get using it straight away. And if they like it, maybe it expands organically. And so in some interesting way, you have this kind of organic movement building for some of these really fantastic platforms. And often the procurement or the CTO are like the last guys to hear about it. They only hear about it when half the company is using this stuff already. That's a really interesting, almost viral model for these companies where their users actually become almost their sales force.
Absolutely. Developer movement and DevOps is kind of one of those bigger picture things going on, right? It's not so centralized as you said, it's coming from the top down. Growing organically is a great way to get buy-in from the people who will be using it the most.
Well, let's take a look at what's happened to some of these investments over the last couple of years. Here's their overall market performance. And we can see some really interesting happening here. This goes way back to, it looks like 2004 through 2022. Look at that green line. That's basically the average valuation of SaaS companies compared to the rest of the market. And look at something really interesting happened really in the last year or two. Now, we should note, let's take a look at this crazy y-axis, right? We're looking at 21 times growth at the peak from 2004 compared to the S&P and the NASDAQ, which are languishing down there at like 2 or 3x growth over that same period. SaaS companies almost 10 times the growth, but they've taken an absolute precipitous drop off in valuation just really in the last year and a half to 2 years. That's happened, I think, for two reasons. Now, as we all know, growth stocks have sold off for very good reasons that we know about. Supply chains are really struggling and impacted. Inflation and interest rate rises. Of course, also the horrible situation with war in Europe. Major factors that are impacting growth stocks. But actually, there's something else going on, I think, for software as a service companies. The world we live in today is kind of an era of higher expectations. When it really comes down to it, we expect things to be effortless. And if we rewind back to I suppose, let's call them first generation SaaS providers, they did all the stuff we just talked about on the last slide. They made it really easy to buy, install, and manage their services, kind of land and expand, get them into the organization. But actually, in some cases, they largely mimicked on-premise applications with the user experience. And it was just a cloud version of the thing you had already. Not all SaaS companies are created equal. And as well as being easy to buy and deploy, I think the best SaaS investments, particularly those that are targeted at smaller companies, have business models that are self-service and readily adopted by the end users. You want that organic growth. You don't want to have your salespeople and your consultants in there to help a customer come up to speed and grow their use of the product.
Luke, this is just a phenomenal graph. When you look at it and you think about it over a 15-year period, getting a 20x return, 2,000 return, it means for every $10,000 you put in, it turns into $200,000, even if you're investing in the entire sector. That is a movement. That is a huge win for any investors to think about it that much. And it just kind of shows how software as a service has become the new normal for all the reasons that you just pointed out in the software world. And I'm sure as you're about to show us in the coming slides, it seems like the right-hand side of that graph has been a reset of expectations. It's been certainly an interesting time right now for us to be reconsidering this sector again.
Growth stocks have sold off. We're in a bit of a bear market right now. And I want to weed out the best investments that have just gone down with the market from the ones that actually are suffering for very good material reasons to the way they operate. I think if you talk to any investor and you ask them to pull out one metric that they think is one of the most important things, then sustained revenue growth is really up there. Revenue isn't the most important thing on its own. Not all revenue is created equal. I'll give you an example. If I ran a small company, I could generate almost infinite revenues by selling dollar bills for 80 cents, right? Everyone's going to buy that and they're going to cycle their money through my organization until I run out of cash. It's not just good enough to be selling dollar bills. You have to do it profitably. And the framework Harvard Business Review took to this was to say good quality revenues are predictable, they're profitable, and they're diverse. So here's a couple of metrics you can use when you're assessing a company to see if it has those attributes of predictability, profitability, and diversity. So one thing I like to look at in predictability is something called DBNR, dollar-based net retention. And ideally, you want that to be over 120%. So what does that mean? That's basically how much revenue growth does a business generate without acquiring new customers. And if that number's over 100%, well, on average, your customers are spending more and more with you year after year. So even if you didn't add a single new customer, you're going to keep growing those revenues. Obviously, you have to consider churn of your customers too. Another good aspect, I think, to help you measure predictability of revenue is the customer lifetime value. How much money do you actually earn from a typical customer overall in their lifetime of their engagement with you? Got a little picture on the right-hand side of the slide here. Lifetime value is really the kind of red triangle plus the green triangle, and who knows where that green triangle ends, right? Could run on forever. So then if we look at profitability, when I talked about that selling dollar bills for 80 cents, well, a good way to measure that is through something called the gross margin or gross profit margin. That's kind of how much of each dollar you earn do you hang on to. That's really important because it means you're retaining your revenues in the company and they're falling down to the bottom line. It's money that you keep that you can use to reinvest into the business. Software companies typically have high margins compared to other industries. For a good SaaS company, you're looking for a gross margin over about 70 or 75%. You also want a low payback period. On my little diagram here, you can see that's the point where you've earned back the money it cost you to acquire that customer in the first place. There's no real guideline here, But the shorter the payback period, the quicker you're going to get to profit with that next customer. And that's going to help your business model. So what's the magic number? It's basically a measure of sales efficiency. What it's saying is, for every dollar of sales and marketing spend, how many dollars of recurring revenue do I create? So if I have to go and spend maybe $1 million to acquire my next 1,000 customers, if I can be generating at least $1,000 in recurring revenue from all of those on average, well, I'm kind of recovering that sales and marketing spend. And clearly, if you're a growth company, you're probably pumping a ton of cash into sales and marketing along with R&D to grow the company. So you're not necessarily looking for a company that's generating a magic number above 1, but you're looking for a number above 0.5, 0.75, shows you're on the right trajectory. And it also, if you're running the company, gives you an indicator as to when you should start really pushing the sales and marketing lever. And typically that's judged as being over about 0.75. And a fun little metric for SaaS companies particularly is something called the Rule of 40. And there's lots of different ways you could add this up. There doesn't seem to be an industry standard, but typically I've seen it calculated as your revenue growth percentage plus your EBITDA margin. Sometimes I've seen free cash flow margin, sometimes even gross margin. If you add up those two things, you want a number that's greater than 40. So what that's telling you is either you're growing revenues at a really good rate, or you're really profitable with the money you're earning, and ideally a combination of the both. And then if we think about the last one of the Harvard Business Review's criteria for high quality revenue, is that revenue diverse? And really, that's no more complex than saying, do we have low customer concentration? Ideally, we don't want any single customer that's more than 15% of revenues. Because if you lose that customer or the business relationship goes sour, well, that could really impact you quite materially. And of course, the other side of that payback period and customer lifetime calculation, if you have low customer acquisition costs, the amount of money it's costing you to buy each customer, to bring them on board, if those costs are low, well, again, that's just going to help your model. It's that minimizing that red part of the triangle in my diagram on screen. So we've taken a look at a couple of tools to help us assess the quality of a SaaS investment. Let's take a look at a couple of investment ideas. So at 7 Investing, we use a whole bunch of really, really good paid and free analytical tools for our stock research. I will give a shout out to Y-Charts. It's fantastic. But there's a bunch of really great free tools on the internet. And for today's video, I thought I'd use one of those that's available to everybody. And it's a set of dashboards that are published by a firm called Meritech Capital. You can find them at meritechcapital.com. So here's a really high-level dashboard for all the SaaS companies that they're tracking. And what we're plotting here is revenue growth against valuation. Basically, you're looking for stuff in the bottom right-hand side of this. Higher growth, lower valuation. That's a good starting point for doing your investment research. So Simon, I've taken a look at a whole bunch of software as a service companies, and I've applied some of the metrics we looked at on the last slide, and I found 3 investment ideas I think are really interesting right now. Unfortunately, we are nearing the end of this introductory video, but if you click below, we would love the chance to email you a link to part 2, where we'll take a look at those 3 companies.
It's fascinating, Luke. Those last few slides especially, I think were very insightful. It's something that I think would be great to print out and put right on my screen as I'm thinking about this sector. It's no surprise, right? Why SaaS has become such a great industry to invest in. I mean, you can see the scalability of getting a developer base that's really, really interested and bought in, organically growing that through the organization. It's less expensive to acquire them because you've already got internal champions that are pushing for this. It's usage-based, as you mentioned, right? This is something that's kind of organic based on how that grows is how it's also built and the revenue is built. And then back to the point she made about the high quality revenue. And there's another study from Boston Consulting Group too that says that between 50 and 70% of a stock's long-term return is tied to profitable revenue growth, which aligns perfectly with this sector too. It's a fascinating sector. I'm actually really excited now to see the 3 ideas that you have, which stand even above the 20x returns that we've shown, but they're really the best of the stock ideas here.
Fantastic. Thanks, Simon. And thanks for that reminder. If you'd like to hear my 3 great SaaS investment ideas, click the link and we'll email that out to you. We're looking forward to doing that. Let's do a quick long-term takeaway though, just to wrap up this short introductory video. SaaS companies, as Simon just said, provide core functionality to their customers, either saving them money or increasing their profits. And so that makes SaaS incredibly resistant in an economic downturn, when other companies might see a drop in revenue because they're so embedded in their customers' way of operating, SaaS companies are really valued mostly on their future revenues. So what you're really looking for is strong and sustained high quality revenue, the most important characteristic of a successful SaaS investment.